Welcome to the latest Old Mutual Multi-Managers quarterly video update. My name is Izak Odendaal. Monine is taking a well-deserved break, so I'll be leading the discussion today, and there certainly is a lot to talk about. With me today is Ameer Amod and Michael Dodd. Now, if we look at the overarching macro story of the last quarter, it really has been about persistently elevated inflation and the central bank response to that. In particular, we've seen the US Federal Reserve hiking its policy interest rate all the way up to 1.75%, and they've indicated they could go above 3% by the end of the year. If we look at what's been happening to inflation, some signs of it easing. Commodity prices have come down quite a bit. We've seen some of those supply chain issues becoming unblocked, and we've also seen the consumer shifting spending back to services from goods. So there's some signs of goods inflation coming down, but by the same token, service inflation is increasing, and that'll keep central banks on guard. And with elevated inflation and rising interest rates and the squeeze on consumers, it's no wonder that people are increasingly talking about recession in the major developed economies. So yeah, as you can imagine, that played havoc on markets in the first half of the year. So Ameer, let's start with you. What happened on global bond markets?
Yeah, Izak, if you actually look at year-to-date numbers for global bonds, they've been down about 14%, and the local bond market has been down about 2%. So certainly a large move in bond yields globally. And the reason for this, Izak, we know is that with higher inflation, central banks do not want inflation to actually spiral out of control. And in fact, it has. We have certainly seen evidence of inflation broadening. In 2021, you had about $17 trillion $17 trillion worth of bonds trading in negative yields. Today, it's at a very low number. So the reason for this is, as we know, we are concerned about inflation spiraling out of control. So markets have reacted accordingly. If you look at the US 10-year, in early December, it was about 1.35, mid-June about 3.5%. So we can see that the movement in bond yields has resulted in these large drawdowns in global bond markets. So, but I think what's important, Izak, is that we cannot ignore these valuation levels. At 3.4%, certainly the US 10-year bonds are very attractive. But what's even more interesting, Izak, is that if you look at the US 10-year today, it's around 2.9%. So it's actually strengthened from its high of 3.5%. So what the market is telling us is that inflation is not so much of a material concern at the moment, but the shift has focused onto growth concerns. Yeah, so I think one has to pay very careful attention to the valuation levels that we are seeing in global bonds. US high yield is trading above 7%. So these are valuations that we can certainly not ignore.
So Michael, turning to you, obviously bonds were negative in the first half. Equities also negative, so global investors had nowhere to hide. What were the standout features of global equities in this period?
Yeah, as you say, there's been nowhere for investors to hide. It's been a pretty brutal start to the year. The MSCI All Countries Index, which is our global equity benchmark, that was down 20% in the first half of the year. That is the worst start to a year that index has had on record. It has a fairly short record, but that 20% number is fairly significant because it's broadly been adopted as the definition of what constitutes a bear market. And now we have a lot of developed market equities that now fall into bear market territories, having had declines of more than 20% from peak to trough. One of those being the US market. The US market, obviously the biggest constituent of global markets, the S&P 500 down 21% in the first half of the year. It's the worst start to the year for the S&P 500 since 1970. So you have to go back more than 50 years to find the worst start to the year for them. From a style perspective, it's definitely favored you to be more value aligned than growth aligned. The value index has held up a little bit better, which hasn't really been the story for the last decade or so. And you've seen a lot of sell-offs in particularly some of the growth names, and in particular the likes of the unprofitable tech stocks that are listed in America that trade at very demanding valuations. From an emerging market perspective, they haven't been spared, but have held up marginally better than developed markets have. And quite interestingly, within emerging markets, we've started to see a little bit of a turnaround in China in particular, where China was basically the only major global equity market that posted a positive dollar return in the second quarter. And where we find ourselves at the moment with global equities as a whole is, as prices have come down, valuations have come down with it and are starting to look a little bit more interesting, I think, from that perspective, particularly more than they have done in the recent period. But I think the overarching concern is on earnings and what the earnings outlook looks like. There's a lot of uncertainty there, and particularly, as you mentioned, the risk of recession, what that might mean for company earnings looking forward.
So those forward-looking valuation numbers not necessarily as attractive as they seem, and therefore we haven't increased global equity exposure despite the sell-off, but we're certainly paying close attention to it. Ameer, global bonds was an area where South African investors did not pay any attention to up until recently. Is that going to change, you think?
Absolutely, you are certainly correct. We haven't been paying much attention to global bonds. And Izak, as I mentioned early on, with $17 trillion of debt trading in negative yields, why would you want to be exposed to the global bond market? But as I pointed out, certainly the valuations have become attractive. However, if you look at South African bonds versus global bonds, the yield opportunity in South Africa has been quite phenomenal. So hence our preference for local bonds versus global bonds. That being said, Izak, with rising bond yields, certainly there's an opportunity now in the global fixed income space, especially in developed market bonds. And I think the increased offshore allowance will certainly give us the opportunity to look into more subsectors of the global fixed income market. So certainly opportunities in that space in terms of allocation. And of course, with talks of recession everywhere, one has to pay a lot of attention to the valuation opportunities that now exist in developed market global fixed income. And I would say specifically the US market. In terms of this, Michael alluded to recessionary conditions. Certainly, it does provide a bit of immunity if that episode has to come to the fore. And as we know, Izak, in terms of the risk that you mentioned earlier on, higher inflation, higher interest rates, the war, consumer confidence, any of these, as well as a combination of these risks, can actually tip the world into a global recession. So hence I say, when there's opportunities in global fixed income, one has to look at that quite acutely.
So if we turn to the local situation, the South African economy recovered much better than expected and much quicker than expected from the COVID shock. So in the first quarter, the GDP number actually took us back to pre-pandemic levels, which was obviously very good news. The outlook, however, has changed quite a bit. We have record high petrol prices, rising interest rates in South Africa as well, consumer confidence taking a big knock. The same sort of factors that we've seen globally, but we also have our own homegrown speciality of load shedding, which is at the moment running at stage 6. So Michael, given this scenario, South African equities actually have held up pretty well, all things considered.
Yeah, South African equities have been the place to be for a change, particularly in the first quarter. The second quarter was a slightly different story. So the first quarter, at least, we had the South African equity market delivered positive returns. Second quarter, we weren't as immune to the pressures on global markets, and we joined the global market sell-off. But first half of the year, the capped SWIX, which is our South African equity benchmark, that's down roughly around 4.5% in rands, and has done far better than what you've got out of global equities. In terms of what's driven that, the financial sector has done well in the first half of the year, and in particular the banks. The banking sector has performed quite well. It is a reasonably sized chunk of our markets, roughly around sort of 18% of the capped SWIX index. And the banks have, I think, benefited from an environment post-COVID where trading activities picked up. They've reported some pretty decent earnings and have also released some of the provisions that they built up during that time. So in pretty decent shape, that particular sector of the market. Additionally, some corners of the resource market have done quite well. I say some because it hasn't been entirely smooth sailing. Resources held up really well in the first quarter as commodity prices peaked, but as those have come back down from their highs, we've seen particularly some of our resources counters come down by the same amount. The one sector within resources that is a bit of a standout is the energy sector, that being your producers of things like oil, gas, coal. So the likes of Sasol have done very well year to date. The likes of Exxaro and Tungela, who are coal producers, have done quite well. They're a much smaller component of the market. But all of those companies that have been, I think, where energy prices and those commodity prices are elevated, and where you're seeing the pressures and the energy issues around the world, they've, I guess from a commodity price perspective, benefited from that to a certain extent. And then if you look at our industrial rand hedges, it's been a bit of a mixed bag. So first half of the year, British American Tobacco, a consumer staple company, did very well, whereas a more discretionary company like Richemont, which hasn't been sort of unaffected by the macro issues that are going on, has done much worse. And within our technology sector, which is predominantly Naspers and Prosus, two effectively Chinese internet companies, they have, while it's still negative year to date, we've seen an extremely strong rebound, particularly in the second quarter, from those companies.
And despite the relative outperformance, valuation is still attractive for SA equity.
They are. I think South African equities at the start of the year had a very favorable starting point, and we are lower, I think, from a pricing perspective. So at the end of June, the forward PE on the capped SWIX was 8.4 times, so a single-digit forward PE. That is cheap, both relative to its own history, but also cheap when you compare it to where other global and emerging markets are trading. I think similar to global, though, the overarching question is on earnings, and the South African companies don't work in a vacuum. They aren't going to be immune to what is happening globally. So the same questions that we have over the earnings outlook globally, we have locally, and where we've got our own unique issues like load shedding, like you said, that particularly affect those that operate predominantly in South Africa. But on the whole, where valuations are at the moment, probably a reasonable margin of safety in South African equities.
Ameer, you mentioned the local bond market did not escape the global sell-off. What is your view on the local bond market? Still attractively priced?
Michael made the point earlier that South African equities is the place to be. I would say that applies to South African bonds as well. So Izak, I think what's interesting is if you look at South African bonds, if you look at the 10-year bond, you're getting a yield about 10.5%. So certainly one is getting a lot of protection in South African yields. So if you compound those yields over the longer term, your total return for bonds looks quite attractive forward-looking. So if you look at the risks in South Africa, the structural impediments that we face in South Africa, I mean, we're well aware of those risks, but the market is compensating you for those risks. So a lot of the time we are concerned about high levels of employment. You alluded to load shedding, etc. So while we are worried about these concerns, I mean, these impediments have been there for a while now. I mean, if you look at the last 2 or 3 decades, we've been faced with issues such as load shedding. We've seen episodes of high inflation, etc. However, if you were to invest in the bond market in the last 2 decades, you'd have got about close to 10%. So I'd say about 4.5% to 5% above inflation. So yeah, so this tells you that a lot of these risks are effectively priced into interest rate markets. So currently, like I pointed out, with the SA 10-year offering 10.5% yield, if yields have to weaken, assuming they go to 12%, you are compounding at a much higher rate into the future. So your total return for bond is very attractive. And if yields strengthen, as we know, you get a huge capital injection. And if assuming that a yield move from 10% to 8%, there's certainly a huge capital injection, but the return that you're likely to get is almost double-digit returns. And it's actually equity-like return. So it tells you that there's a lot of risk that is priced in the South African bond market. So while we are spending time worrying about these risks, there's a price in interest rate markets, which I've mentioned earlier on, and you are certainly handsomely compensated for those risks.
Thank you. Okay, so if I can summarize, it is certainly a very uncertain environment. The global outlook is quite murky, and I think investors should expect market volatility to continue for some time until we get more clarity on some of these issues that we spoke about today. We were quite cautiously positioned from the start of the year. We increased global cash levels. That's turned out to be the correct call. We also haven't rushed to make use of the bigger offshore allowance under Regulation 28, and that's also proven to be the right call. But obviously, we will monitor these things quite closely. I think looking ahead, it remains very important for ourselves and for investors to focus on valuations and not to get carried away by the day-to-day movements in markets. And of course, to ensure that the funds that we manage for our clients are appropriately diversified to meet their respective investment targets. So thank you very much for watching. We'll speak to you next quarter.